Hi everyone, thanks so much for watching. Today's video we're going to focus on a neat little concept where we show someone basically the impact of assuming you're going to be healthy and rewriting term over time versus buying permanent right now. We're illustrating this in life design analysis software, and again, life design analysis, if you're not familiar, is a presentation software, but it's also a very analytical program that can compare any different insurance option for your client. The whole idea and the whole reason we created it was because 9 out of 10 consumers aren't aware of their insurance options, and if we can show them or communicate in a better way to them, we use visuals to help kind of illustrate the different scenarios. We find our insurance agents increase their sales, so if you haven't done so already, sign up free. There's a 30-day free trial. Today's concept, like I said, I'm going to be illustrating a term repurchase or rewrite versus permanent now. And again, this is a scenario you can use if you have clients who are sort of maybe procrastinating and saying, no, look, I'll keep buying term, and they assume they're going to be healthy. And even if they are, again, I want to show kind of some of the differences between these products. So I'm going to set up a brand new case here, and I'm going to go with my sample client. And this one happens to be a 50-year-old male. Again, this concept works with really any age of client. Again, you can illustrate over time the differences between two products. Now, generally when I show term, I show sort of a guaranteed renewal, because that's something I can actually predict, and I can actually guarantee that in the contract. I'm going to pick the $1 million of face value to focus on today, but as I said, it still works with any different face value. Now again, normally when we're searching for term, we just hit plus term and it searches out the entire market for us, but that is going to add the guaranteed renewals. And again, as I said, we're dealing with a client who's maybe resisting permanent, or just assuming that they're going to be healthy forever and saying, look, I'm going to keep buying term. So whenever we're doing something like that, we want to use our plus manual tab here, and I'm going to select term 10. Now again, this gives us the ability to actually manually input the different variables. So again, in last week's video, we showed it using the first term 10 premium and then using the remainder of the renewals for a UL. But today's video, we're actually going to show it as if this is a term 10, and I'm going to show it as a rewrite or repurchase. And I'm going to say every 10 years. Now again, anything I update here is going to be updated in a legend, so whatever you put in here is actually really going to communicate to your client as well. Now down here in the description, I really want to add a disclaimer, so I'm going to say this assumes two big things. So I'm going to say this assumes good health, that's the biggest one, and current pricing. So there is a chance that current pricing could change, because we're going to be estimating a repurchase at a future age. The biggest assumption though that we're making is that good health condition. Now basically when I come down here, you can see there is an initial premium in the first renewal. So what I really want to do is I actually I can look up the initial premium and all those renewals in our software, but I'm actually going to come over here and I'm going to say I'm going to design basically a quote for a T10. I just want to fetch these rates really quickly. I'm going to do this annually as well. So I'm going to say this coverage is not monthly, I want it annually, but you could do this either way. So once I've got my client here, again, same 50-year-old male for $1 million, basically all I want to do is I want to grab that term 10 premium for the first 10 years. Again, normally if you did this search in our software, it's going to turn up this same schedule, it's going to add all these guaranteed renewals. What we're going to do though is I'm going to add this to the initial premium. Once we add the first 10 years, now we want to assume that they're repurchasing it at an increased age. So all we're going to do is we're actually going to go back here. We're going to change our client to age 60, and we're going to update those rates. And again, basically what we're doing is we're assuming they're going back with good health. Again, you could build in a rating if you wanted into this as well. And again, we're grabbing that premium. So again, now instead of that guaranteed renewal, we're assuming they've gone back, given new meds, and again, they've been rated standard, and this is the new premium. So it's going to be an increase. It's not going to be as drastic an increase as the guaranteed renewal, but again, it is still going to be an increase because of that age. Now again, we're going to assume they do this once more. They come back. Now they're 70. They repurchase insurance again. And now again, our premium jumps. However, it's not, again, as drastic as that guaranteed renewal. But that's what we're trying to illustrate to them. So I'm going to go back and keep entering these renewals. Now, again, if you have a different age of client, you may have more of these renewals or less of these renewals to do, but keep going back until this basically happens. Now, watch, if I try and reissue this policy and buy more term at age 80, we can see what happens here. Premiums can't be calculated due to errors. Basically, this client is over the maximum allowed 75 years old for term 10. So what we basically have to do is for the final renewal, we have to say, you couldn't purchase it anymore, we're going to use that guaranteed renewal as the next one, because they would still have the option to keep the insurance or convert it at that point, well, unless they're over 65. But we're going to illustrate and we're going to say that's your next renewal. So again, we've got our repurchase renewal schedule entered in there. It's still going to be renewable till age 85. It's still going to be convertible till 75, so we can leave that in there. We don't have an issue date, but again, this could be done with an existing policy too if they were into that. And we're just going to click save. So now we've got our repurchase plan input in there. And now we can compare it to any sort of permanent product we want. So again, we could do a universal life if we wanted and show, this. Here's how it compares to buying UL right now. I'm going to compare it to a whole life plan. So I'm just going to actually add a Canada Life whole life here. And again, you can design whatever you'd like. If you haven't watched it, watch our whole life video to see how you can input different options. I mean, you could even use a term rider in here if you really wanted to max it out. But essentially, I'm just because I've got the Canada Life software up here, I'm going to say let's do it to a Wealth Achiever. I'm going to do a pay to 100. And I'm going to change this back to our issue age because we're saying, we want you to buy permanent right now. Coverage, we're going to make sure it's the same at $1 million. And again, you could design whatever premium offset you'd like. I'm going to be pretty safe here and say 16. Paid up additions, perfect. Now, basically, design the quote whatever you want to show them your permanent solution. In this case, I'm using a par product. And again, I'm just going to grab that information and paste it into Life Design Analysis here and upload it. Now, I can also give this a specific name, so I can just say, I don't just want to call this Canada Life Whole Life. I want to give it some extra detail. Let's just generate the case and see what it looks like. And again, this is a very compelling kind of comparison for your clients who are maybe procrastinating and say, I'm going to be healthy, I'll keep buying this term stuff, and maybe even they think they'll invest that difference. And again, we can actually show that too. So let's skip past kind of our, again, we've done a needs analysis for this client. We'll get down into basically our premium schedule. And again, this is what we would show our client, showing a term 10 rewrite or repurchase every 10 years. We've got our disclaimer there, and again, this is a really big one, especially, you might even want to put this one in all caps, assumes good health. We've got a renewable till age and convertible, and we can again see that schedule where it is, a little bit lower. I mean, of course, it increases in price because of their age. However, we can see that big, last renewal that because they can't repurchase insurance. And again, we can compare it to, whatever permanent product we want. Well, ultimately, this is sort of what the annual premium schedule looks like. And again, I really like to compare. At this age, I like to think about, would you want to drop your insurance here at age 79, in 30 years? Would you still need insurance at that point? And again, if the answer is yes, well, again, there's really only one solution, and it is permanent insurance. Now, the other thing, though, again, they might say, well, I'll just drop it. I don't need insurance at that point. We want to make it worth their while. So I really want us to focus in on this difference here, and we can see it's roughly about $300,000. We'll get an exact number when we look at that presentation summary. Again, I think the important thing here is, though, that we're saving money well before life expectancy, and again, we've got something that's guaranteed in place to be permanent. Now, the other thing is, of course, that permanent plan we added has some cash value, and we can see that even at the 15th year when it's going to have the biggest premium deposit difference, that it's actually going to have more cash than we put in. And again, equally important to show some of those guaranteed values, or maybe more importantly, the reduced values, as they've issued a dividend for quite a long time, over 100 years. Let's get down again. We can show the paid up addition here, but let's get down into that cost comparison, because this is one thing that I really like here. Again, if we focus in on that magical 30 number where, maybe our client says, well, look, I'll just dump it at 30 years. The difference at that point, again, I said it was roughly $300,000, is actually $290,325 of difference. So we would have paid a little bit more into that Wealth Achiever at that time. However, for that premium deposit difference, you can see we have $870,000 of cash. And that's really how I'd want to kind of position it. And so I'd say, even in the best case scenario, you're perfectly healthy, you're Superman, you keep buying term until they won't let you anymore. This is the premium deposit difference. And, there's a cash value for it. So again, if they can afford par. Now, this would be a curious scenario. Let's go back to this case. And I'm going to take out the par. And let's see how this looks against even a UL. Again, the UL may not make the case, for a pure premium deposits, but let's just search for a minimum funded UL here and see if we can make a similar argument and say that even if we were to repurchase term, we're going to end up somewhere around the same premium deposits. But in one scenario, we're taking absolutely zero risk because, again, all we have to do is pay the premium. We're guaranteed to have the insurance benefit in place. So let's kind of look at this a different way. And again, we'll see, I've hidden the Wealth Achiever there, that PAR product, and now we're going to look at just a T10 versus a UL. And this would be a minimum funded scenario. So, feel free to look at this versus, maybe other ones. I mean, you may even want to look at it versus an Empire term product that turns into a T100. So again, it's going to be a pretty close comparison, especially, it'll be interesting to see at that 30-year mark here. But again, we've got our level premium. Yes, the term's a lot lower until that age 70. And a lot of times I like to say, at that age, when you're thinking about your retirement and you're on a fixed income, are you going to be able to afford that increase? And again, we certainly won't be able to afford the increase here, that final guaranteed renewal, because we can't purchase term anymore. So again, we would lose that insurance at age 79. Yeah, I think, again, fantastic compare here. A little bit more expensive if they decided to dump it here at age 79. But again, on a permanent basis, it's well before life expectancy. We're giving them the more affordable option. We're taking zero risk. And I think it's a great solution. So let's look out again, though, at that critical 79, 30-year mark. The premium difference is $165,000. Again, we've guaranteed them a solution, though. Here they've taken that risk because, again, they may have got rated. They may have got declined altogether. Again, it's not guaranteed that they'll get issued term, particularly at standard at these ages. So, again, you may want to build in a rating or use guaranteed renewals earlier, depending on the history of your client. That's really your option. But I just wanted to show you a couple different ways you could set up a term rewrite versus permanent. Thanks so much for watching. Again, if you want to share this case with your clients, again, you can click the share button. That's a preview to our upcoming feature. Take care.